Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about American International Group Inc. Annual Report. American International Group, AIG, offers a wide range of insurance products to various customers worldwide. At its core, the company provides commercial and industrial property insurance that covers businesses against natural and man-made disasters. This includes business interruption and package insurance, as well as general liability, environmental and workers' compensation insurance. In addition to these services, AIG also offers specialized insurance products such as marine, energy-related property insurance, aviation insurance, and political risk insurance. The company's portfolio solutions cater to businesses with complex risks, providing trade credit, trade finance, and other financial services. AIG's personal lines of business include voluntary and sponsor-paid accident and supplemental health insurance, as well as auto and homeowners insurance. The company also offers extended warranty and device protection insurance, home warranties, and related services for high-net-worth individuals. Furthermore, AIG provides mortgage and other loans receivable, including commercial mortgages, life insurance policy loans, and commercial loans. With a rich history dating back to 1919, AIG has established itself as a leading global insurance company with a diverse range of products and services catering to various customer needs. The American International Group, AIG, stock price has experienced a slight increase over the past year due to several key news events. One of the most significant factors contributing to this growth was AIG's excellent fourth quarter and full year 2025 financial results, which were announced on February 10, 2026. These results exceeded analyst expectations for both earnings per share, EPS, and revenue, with a notable increase in adjusted after-tax income per diluted share of 43% to $7.09 for the full year 2025. The strong financial performance was also reflected in AIG's core operating return on equity, ROE, which reached 11.1%, surpassing the company's target of 10% plus for 2025. The general insurance segment demonstrated significant improvement, with underwriting income increasing by 22% to $2.3 billion due to lower catastrophe charges and favorable prior year development. In addition to its strong financial results, AIG has also made strategic capital returns to shareholders, including share repurchases and dividends. The company's board of directors declared a quarterly cash dividend of $0.45 per share on February 10, 2026, and AIG returned a significant $6.8 billion to shareholders in 2025. AIG's strategic partnerships and investments have also contributed to its stock price growth. The company completed acquisitions of minority ownership stakes in Convex Group and Wunks Corporation, which are expected to positively contribute to earnings and return on equity. Furthermore, AIG formed Syndicate 2479 with Blackstone and Amwins, and invested in CVC's new private equity secondaries Evergreen platform, aiming to contribute to earnings, EPS, and ROE in 2026. Overall, AIG's strong financial performance, strategic capital returns, and partnerships have driven its stock price growth over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of AIG's financial performance. One key factor contributing to potential revenue growth is the increase in available-for-sale investments, which rose from $64.006 billion to $71.032 billion between 2024 and 2025. This suggests that AIG has successfully invested its funds, generating a positive impact on its revenue. On the other hand, a decrease in credit exposures to non-U.S. governments may indicate a reduction in potential revenue streams. AIG's aggregate credit exposures decreased from $8.131 billion to $6.539 billion between 2024 and 2025, which could negatively affect its revenue growth. The increase in European credit exposures in certain sectors, such as financial institutions and non-financial corporates, may also contribute to potential revenue growth. However, the decrease in sovereign sector exposures suggests a more cautious approach by AIG, potentially limiting its revenue expansion. Lastly, stable lending activities, as indicated by the consistent weighted average debt service coverage ratio for commercial mortgages at 1.8x between 2024 and 2025, suggest that AIG's lending business remains steady, contributing to its overall revenue stability rather than growth or decline. AIG's net income and profit margins underwent significant changes between 2024 and 2025. In 2024, the company reported a loss, but in 2025, it recorded a net income of dollar amount, indicating an improvement from the previous year. The reasons for this change are multifaceted. The growth of surplus, maintenance of sufficient liquidity for unanticipated insurance claims, and preservation of capital were key factors that contributed to AIG's improved financial performance. Additionally, the company's hedging activities also played a role in its financial success. Despite the lack of explicit information on profit margins, these factors suggest that AIG's investment strategy was effective in generating revenue. The recognition of gains, losses, related to net investment hedge relationships further supports this conclusion. The fact that AIG reported gains of $116 million in 2025 compared to losses of $42 million in 2023 indicates a significant improvement in its financial performance. Overall, the changes in AIG's net income and profit margins can be attributed to a combination of effective investment strategies, hedging activities, and preservation of capital. The analysis of AIG's debt level and interest expenses reveals a subtle shift. The weighted average loan-to-value ratio for commercial mortgages increased from 65% to 71% between December 31, 2024, and December 31, 2025. This slight increase in debt level is the only concrete indication of change. Conversely, there is no clear information regarding changes in interest expenses, leaving this aspect of AIG's financials unchanged. The financial performance of various regions and segments has been analyzed based on the provided summaries. On a positive note, investments and municipal bonds have shown strong performance. Investments saw an increase of $7.026 billion in available-for-sale securities from December 31, 2024 to December 31, 2025. The U.S. municipal bond portfolio also demonstrated high credit quality, with 98% of the portfolio rated O or higher. However, some regions and segments have underperformed. Credit exposures to non-U.S. governments decreased by $1.592 billion from December 31, 2024 to December 31, 2025, indicating a decline in this area. Commercial mortgages also experienced difficulties, with a significant increase in non-accrual status loans at the end of 2025 compared to the previous year. Management's discussion of the company outlook and strategy at AIG is centered around several key areas. The primary focus is on growing surplus, maintaining sufficient liquidity to cover unexpected insurance claims, and preserving capital. This approach aims to ensure the company's financial stability and ability to meet its obligations. In terms of market trends, risks, and opportunities, management acknowledges the importance of monitoring these factors in order to make informed decisions. AIG's lending activities are also subject to strict credit quality metrics, such as debt service coverage ratios and loan-to-value ratios, to minimize risk. Furthermore, management is proactive in managing market risk through the use of derivatives and hedge accounting. This approach helps to mitigate foreign exchange risk associated with non-U.S. dollar functional currency foreign subsidiaries. By taking a comprehensive and forward-thinking approach, AIG's management aims to position the company for long-term success while minimizing potential risks. There were no acquisitions mentioned in the summaries provided. However, there was one notable divestiture-like transaction involving AIGFP, which was deconsolidated from AIG's results. This resulted in a pre-tax loss of $114 million for the year ended December 31, 2022. Although not explicitly stated as a divestiture, this move effectively removed AIGFP from AIG's consolidated financial statements, indicating a significant change in their business structure. That concludes the financial summary for American International Group, Inc. Feel free to comment below, and I will be happy to answer them when possible.